So let's finish up the chapter, and then there are 3 problems we will go through later. And then there are only 2 problems that you'll need to do on your own. So it's going to be a pretty light chapter as far as that goes. So again, we are learning about long-term liabilities, right? Long-term meaning debts that you have to pay more than a year from now, right? We talked about how are the prices established, for example, for bonds. How do you amortize loans and bonds? There is the straight line method, which is fairly simple, but there's also the effective interest method, which is not that simple, unfortunately. We'll go over that some more. We talked about how to journalize when you issue the bonds, when you pay out the interest, and also when the bonds mature and you pay out the principal. And then we will get to some special topics related to long-term liabilities. So let's just see what we need to review here. Again, the terms of a loan or the terms of a bond vary. So principal amount, the interest, when it will be due, when the loan or the bond matures, all of those terms differ, and they need to be specified up front so that there's no misunderstanding. So both parties should know what those terms are. So if it's a loan, you would document it in a loan document like a promissory note. We talked about how it's important to distinguish current from long-term liabilities because for investors, they want to make sure companies have enough money this year to pay off their debts for this year, right? So we separate out the liabilities and the assets into current versus long-term. We looked at some of this terminology. So let's see, here we're talking about bonds. The principal is also known as face value or maturity value. What does that represent? What is the face value of a bond? Yeah, it's the amount that the bond purchaser knows that they will eventually get back. It's not necessarily what they paid for the bond, right? But it's what the bond is worth if they hold it to maturity. If they sell the bond, they might not get the face value. They might get more than the face value. They might get less than the face value. But if they hold it to the very end, when the bond matures, that's how much money they get back. So the interest rate, sometimes it's called a stated interest rate. Sometimes it's called a coupon rate. But that's different from the market rate, right? Who determines the stated or coupon interest rate? Who makes that decision? The bond purchaser or the bond issuer? Issuer, exactly. And in fact, they have to get it approved through the state, whatever state they incorporated through. All right, and what else? We saw an example of a bond certificate. Okay, some more terminology. What's the difference between a debenture bond and a secured bond?
The debenture is unsecured.
Yeah, the secured is secured, that's right. And to be secured, it means that there is some asset where if the bond issuer does not pay back the face value, the bond purchaser has a right to that asset, right? So the bond is secured by maybe a building, maybe a bank account, whatever that asset might be. What's the difference between a term bond and a serial bond?
One is paid all at once and one is repaid.
Okay, very good, Jackie. So the term bond, the face value gets repaid at the end. With the serial bond, the face value gets repaid in a series of payments. And what's the difference between a callable bond and a puttable bond? So the callable bond The bond issuer or bond seller has a right to call back that bond whenever they want. With a puttable bond, the purchaser has a right to put it or sell it back whenever they want. So it's really who has the control over changing the date of the bond, being mature, that's not the right word, there's a word, I can't think of the word. But it's if somebody wants to retire, that's what I was looking for. Somebody wants to retire that bond early and say, okay, we're done with that bond. Who has that decision? With a callable bond, it's the seller of the bond. With a puttable bond, it's the buyer of the bond. And a convertible bond can be converted into stock. Right, so what else did we talk about? We talked about how bond prices are influenced by a number of factors. But one of the most important factors is the market interest rate. So as the market interest rate goes up, what happens to bond prices? They go down. Exactly. And if the market interest rates go down, bond prices go up. Okay. The bond prices are quoted in percentages, but the way they're written, there is no percentage. For example, a bond selling at 1, we have to know that that means 100% of its face value. A bond selling at 120 is selling at 20% above its face value. And a bond selling at 0.98 is selling at 98% of its face value. Okay, so we just have to keep that in mind. Actually, it might not even have the point. It might just say 98. And then we'd have to know that means 98%. Okay, we talked about how when you take the annual interest rate and you divide it by how many payments the bond holder is going to get per year, that tells you the interest rate of each payment. So if you have a 4% bond that's being paid out twice a year, then they'd be getting 2% of the face value 2 times a year, right? Which would equal 4% per year. We also talked about calculating the amount of the interest payment. That's the principal times the interest rate, and then times the number of months that you're collecting interest for, divided by 12. We looked at how simple interest does not increase. It just stays the same in every period. But compounding interest increases. So you see that this investor gets $6 one year, $6.36 the next year, $6.74 the next year. And why does compounding interest increase? Because you're getting interest on what? Your interest. On your interest. Very good. And then we got to amortization, right? This is amortization of a loan. So we walked through step by step. Is there anybody that wasn't here on Monday? Yeah? Okay. So I'll just tell you real quickly what these steps are. If you're amortizing a loan, you take the beginning amount, whatever amount was borrowed, and then you have to know what are going to be the amount of the payments. And we don't have to calculate that in this course. In fact, there is software out there that can calculate that for you if you ever needed to know. For example, the website bankrate.com has all these different calculators you can use for different financial things, like amortizing a loan. And it's free. So that would be a good way if you needed to find it out. Unfortunately, they just tell us the amount of the payments. And notice that the payment for this loan is going to be the same all 5 years. Okay, so that part's given to us. What we have to do is calculate how much of each payment is going towards interest, how much is going towards the principal or paying down the loan. So what we do is we take the beginning balance, multiply it by the annual interest rate. Fortunately, these are annual payments, so it's nice and simple. If they were quarterly or monthly, then we'd have to factor that in. But if it's an annual payment, take the beginning balance times the annual interest rate. That tells you how much of that payment is going towards interest. You subtract the interest from the payment to see how much of the payment is going to principal. And that amount that you're paying towards the principal, that reduces the balance of your loan. So then you can take the beginning balance minus the amount that's going to principal to get your new balance. And the ending balance for year one becomes the beginning balance for year two, and you just repeat that process. And that's how you amortize a loan, and it should come out to zero. Sometimes it might be off by a penny or two, just due to rounding, but should pretty much come out to zero at the end. That's how you amortize a loan. And then I did point out that even though the payments are staying the same every year, the amount of each payment that's going towards interest decreases with every payment. And the amount that's going towards principal increases with every payment. So at some point, if you purchase a house, or maybe you've already bought a house and you've got a mortgage, over time, when you make your payments, and if it's a fixed rate mortgage, it stays the same payment throughout the life of the loan, unless you refinance or unless you factor in insurance and property taxes. But just the fixed rate mortgage itself stays the same, but more and more of each payment is going towards principal as you proceed through the loan. At the beginning, the majority of your payment might be going towards interest. And what that tells us, when we have a loan that's amortized like this, if we can pay it off early, we won't have to pay as much interest, right? So if the loan allowed, and in year two, they could pay the full $8,426.07, they would save themselves all of this future interest. But if they can't, then they keep making the same payments, and eventually they'll get to zero. So let's see, we walked through some exercises, some problems. Let's see. Oh yeah, and then we talked about if you sell a bond where the interest rate you're offering is less than the market rate, nobody wants your bond, right? And so you have to sell it at a discount. On the other hand, if you're selling your bond at an interest rate that's better than the market rate, everybody wants your bond, and you can charge a premium. So the discount and the premium both impact your overall interest expense. So what we have to do when we journalize it is we show the discount or the premium when we sell the bond, but then we have to apply that towards interest expense every time we pay interest. And that's the amortization of the premium or the amortization of the discount. Again, there's an easy way to do it and a hard way. The easy way would look like this. So it's the straight line amortization. In this example, the company got $540,000 for $500,000 worth of bonds. So they got a $40,000 premium that they were able to charge. And see that here is the premium on bonds payable, and the face amount is just bonds payable. Okay, so that is the journalization of the issuance of the bonds. Then when they pay interest, if we're doing straight line interest and it's 10% per year, We would just take 500,000 times 10%. And that comes out to $50,000 of interest expense. And that's what they actually pay out to the bondholders. But at the same time, they have to amortize the premium that they got, right? So what we would do is we take out that $40,000. And in this case, it's a 4-year bond. So it matures in 4 years. So they just divide that $40,000 premium by 4 years, and they can amortize $10,000 every year. That looks like this. It's a debit to premium on bonds payable. So you're decreasing the amount of your bond payable with the debit. And it's a credit to interest expense. So you're decreasing your interest expense with the credit. That's the amortization of the bond. All right. And that's the simple way. So any questions on the straight line method of amortization? Okay, then we got to the not so simple way, the effective interest method. So in this case, what you do is if the bond was issued at a premium or a discount, whatever the amount you sold the bonds for, that is your carrying value to begin with. So that's what you start with. Whatever you sold the bonds for. Then what you do is you take the face value of the bonds. In this case, it's 100,000 times the annual interest rate. And that's how much interest you're going to pay out per year. Again, this is annual interest payments to keep it nice and simple. If it were quarterly or semi-annual, then we'd have to break it up, but we'll just keep it simple. So face amount times the annual interest rate. That's the amount we actually have to pay the investors. However, that's not what we journalize over here. We do journalize that in one place, but we have to journalize this too. So what we have to do is we say carrying value times the market interest rate is our interest on the carrying value. And then we subtract that from the actual cash interest payment to get the amortization of the premium. And then we subtract that from the previous carrying value to get the new carrying value. A lot of steps there, right? Let me go through that one more time. The cash interest payment is the face value times the annual interest rate. And then if there are multiple payments in a year, you would divide by the number of payments. Interest on the carrying value is the carrying value times the market rate. And then again, if there are multiple interest payments per year, you would divide by the number of payments. Then the difference between the two is your amortization of either the premium or the discount, whichever it happens to be. And then if it's a premium that you're amortizing, you subtract it from the carrying value. If it's a discount, you have to add it to the carrying value. That's really the only difference. And then by the time you get to the maturity date of the bond, what's your carrying value going to be? When you reach maturity, it'll be the face value. Perfect. So that means if you sold the bond at a premium, it's going to decrease, right? The carrying value will keep decreasing till it gets to the face value. If you sold the bond at a discount, that means the carrying value will increase until it gets to the face value. So that's how you do the effective interest method of amortization. Are there any questions on that? Okay. This is how the ledger entries would look like. So in that last example we saw, again, remember we had to pay out $5,000 in cash to the investors. We had issued a bond payable. We had collected a premium on top of the face value. but then that premium gets reduced by the amortization of the premium when we make the interest payment. And the interest expense gets reduced also by the same amount. Okay. And I think this might have been the last slide we looked at. We check. It is. Great. So let's just, this is an amortization situation here. Let's just take a quick look at what's going on. Well, actually, this is the same thing we were looking at. It just shows year 2, 3, 4, and 5. And you see how the carrying value starts at the original sales price of the bonds, and it keeps getting reduced until it gets to the face value. Now, at that point, you could see we have made five $5,000 payments to the investors. So we've paid out $25,000 in interest. But if you look at interest on the carrying value, if you add up those 5 amounts, it comes out to $20,540, which is the same as the $25,000 we paid out minus the amortization of the premium. It all fits together. It's all there for a reason, so we can properly account for our expenses, our liabilities, our assets. Everything is properly accounted for, but it is a complex system. I'm not going to lie, right? I think you can figure it out by now. All right, so any questions so far? All right. If the bond had been issued at a discount, again, if it was $100,000 face value at 5% interest per year, right? So it's the same $25,000 that would be paid out to the investors. But because this bond was sold at a discount for less than the face value, you see how the carrying value is increasing until it gets to the face value. And in this case, because we sold the bond at a discount, the interest expense is increased. It's the $25,000 that we paid out plus the $8,200 amortization of the discount. Okay, so just keep that in mind. When you sell a bond at a premium, that premium reduces your interest expense. If you sell it at a discount, that discount increases your amortization expense. All right. In case you at any point get confused, if the stated rate of the bond is greater than the market rate, you can sell it at a premium. If the stated rate is less than the market rate, you'd have to sell it at a discount. Okay. We've done exercise 6. We've done all the exercises, right? And skip that. What if the stated rate is the market rate? Okay, well then the bond is sold. Does anybody remember what the term is? At par. Like in golf. Not that I'm a golfer. But that's a golf term, right?
Yeah.
So if you sell the bond at par, that means the amount you collected was the same as the face value. And the reason for that is because the interest rate you're offering is the same rate that a similar bond would sell for in the market. Now, there are all kinds of different bonds, right? There are government bonds, corporate bonds, domestic, international, risky, safe, corporate, government. There's so many different types of bonds out there, right? So when I say the market rate, I'm referring to what is the market rate for a bond like this one, with a similar risk, similar length of time, etc. If you're selling your bond the same rate as the market rate for a similar bond, that's at par. And the journal entry would look like this. You got cash and you issued a bond payable. right? Because when that bond matures, you're gonna have to pay that face value. So it's a bond payable, and that makes it a liability. So we see, in this case, we got cash, assets went up, we issued the bond, the liabilities went up. What if we offer, let's see, a stated rate of 5%, but the market rate is 4%? Okay, again, now we're offering something better than what you could get in the market for a similar bond. Because of that, we could charge a premium. So if we do, let's say we collect $104,460 by selling the $100,000 face values of bond. I don't know if I said that right, but. So in that case, the difference, the extra money we collected is the premium on the bonds payable, right? We've seen that already. And the face value is the bond payable. So then if we look, in the ledger, we would see now we got extra cash. We still have $100,000 of bonds payable. And the rest, the extra money we got is the premium, right? So on the balance sheet, you would see the bond payable. We would see the premium on bonds payable, which is going to show up. I would say as equity. I think that would go in the equity section. Maybe we'll see an example. I think it would go under the equity section. I don't think it would go under liabilities because if it would be a contra liability. So I probably shouldn't have opened my mouth, but maybe we'll see the answer to that. The book value of the bond is the face value plus the premium. But as you amortize that premium, the book value will go down until it gets to the original face value. And at that point, you retire the bond. You pay the investors the $100,000 and the bond is done. If you are offering less than the market rate, so here our interest rate is 5%, market is 7%. Well, that journal entry looks a little different, right? We still got cash. We still issued bonds payable, but we debit discount on bonds payable. So that's going to look like that. Notice that there's a debit to discount on bonds payable, which reduces the book value of the bond. Right, we did that already. Okay, this one, oh, this is calculating the interest. So if this is a 5% interest rate, you take the principal times the annual interest rate. If we're only paying out the interest once a year, our journal entry looks like this. We have an interest expense and we pay out cash. Now in this case, because our interest rate is the same as the market rate, there's no premium, there's no discount, there's no amortization. Nice and simple. Here is a case where there is a premium. And let's see. Okay, the first interest expense in the journal entry. So here we also have $5,000 getting paid out to the investors. Right, so we still pay out $5,000 in cash. But now look at the way we journalize it. Different. Part of that $5,000 is interest expense, but part of it is the amortization of the premium, right? You might recognize those numbers. That was the first year's amortization. I think that was a ways back, so I don't want to go all the way back there. But that's where we do the effective interest calculation to figure out how to amortize the premium. And as I said, that decreases your interest expense. So the interest expense here is the $5,000 we paid out to the investors minus the amortization of the premium. That's how we get that difference. Oh, yeah, here we go. So the premium on the bonds payable was originally this, but we amortized it by $822 for that first interest payment. So this is our remaining premium, right? The interest expense was this, but we reduce it by that same amount from the amortization of the premium, and that is our interest expense. That $4,178, you see, is the interest expense. Any questions on any of those steps? I think this is just this. What is this? Yeah, this is the next year. So year 2, now we're taking the new carrying value times the market rate to get the new interest on the carrying value, right? So in year 2, that would be the amount of the interest expense, and that would be the amortization of the premium, right? But we're still paying out $5,000 to the investors. And then you see it continues to change every year until the bond matures. So now this is taking the end of the first year's premium that was still remaining minus the new amortization, and we get a new ending premium amount. We're taking our same $5,000 interest payment minus that new amortization amount to get a new interest expense. So it just keeps changing every year. Same thing with bonds sold at a discount, which is what we have going on here. Now notice in this case, we pay out $5,000 in cash, but the discount on the bonds payable is credited. God bless you. And then those added together equal our interest expense. So again, when you have bonds issued at a discount, your interest expense gets increased. Right? $5,000 that we actually paid out in cash, that's interest expense, but the amortization of the discount increases our interest expense. And then we see the discount on bonds payable is decreasing again until it's completely gone. When the bond matures is when it will be gone. Next year, same thing. The numbers change, but it's the same process. So we see the interest on the carrying value keeps going up every year. The amortization of the discount goes up every year, and the carrying value goes up every year. So if you're amortizing the discount on a bond, expect all 3 of those columns to increase every year. If they're not, you did something wrong. And with the amortization of the premium, notice that the interest on the carrying value is decreasing and the carrying value is decreasing. And the only thing increasing here is the amortization of the premium. So again, if you're amortizing a premium and it's not following this pattern, you're doing something wrong. Okay, any questions? Right. Yeah, so on the balance sheet, you would see the bonds payable, you would see the discount or premium, and then you would know the carrying value. And on the income statement, you would see the expense, right? Because the income statement has revenue minus expenses. So any expenses for bonds will decrease our profits on the income statement, makes us less profitable, but saves us some money on income taxes. So this slide has a lot going on. The only thing I want to point out here, if you issue the bond at a premium, that premium is going to decrease every year. Like you see from year 1 to year 2, the premium goes down. If you issue a bond at a discount, that discount is going to decrease, but that's going to make your book value of the bond increase. The bonds issued at a premium. The carrying value starts at whatever you sold it for and comes down to the face value. Bonds sold at a discount, the carrying value starts at whatever you sold it for and increases to the face value. If you get confused about that, this slide might help refresh your memory. Okay, so we issue bonds at par, nice and simple. We got cash, we issued bonds, right? Debit cash, credit bonds payable. Then when those bonds mature, the bonds payable goes away. So we debit bonds payable and we pay out the cash. It's the exact opposite of the original transaction. Because we borrowed the money and then we paid it back, right? The interest, that's the tricky part. That's the part that's harder to journalize. So you might remember what I told you on Monday. I'm pretty sure I talked about this. Why do corporations specifically, why do corporations tend to use both debt financing, like loans and bonds, and equity financing, like issuing stock? Why do they use both? Because they could just do one or the other, right? They could just issue stock and never take out any form of debt. Or they could just use loans and bonds, borrowing money, and never issue stock. So corporations typically do both. Why would that be? And basically just so you don't have too much debt and so you don't give up too much ownership in your company. So corporations are typically trying to find the right balance. And that also helps maximize their stock price. Because if investors see you have too much debt, or they see you've sold too many shares of your stock, they don't want to invest. And then your stock price goes down. So since corporations are typically trying to make their stock as valuable as possible, they look for that right balance between debt and equity. Okay. Yeah, so when you sell stock, I'm sure I've told you this before, the investor's taking a risk, right? They're buying part of your business. You get their money. They might never make a profit. They might completely lose the investment, right? You have no requirement to ever pay them back. If, as a corporation, you decide to buy stock back from investors and they're willing to sell it, you can do that. But you're never obligated to buy back to buy back stock from your investors. So you could use that money for whatever you want. You could use it to grow the company. You could use it to pay out bonuses, hire more employees, develop a new product, expand into new markets, pay off some debt. Use the money for whatever you want. It says here, new businesses should have enough cash to operate for 6 months without having to borrow. And that's a good rule of thumb, I think, for anybody. Good idea to have some money stashed away. Think of it as sort of your financial foundation. Maybe it's in the bank or someplace safe. You know, don't just stick it under your mattress where somebody might find it. Put your money someplace safe where you can access it if you need it. Now, if you think, how much would that be to cover 6 months of your expenses? Well, depends. If let's say you have rent of, I'll just say $2,000 a month, and other costs, maybe all your expenses together come out to $5,000 a month. Well, if you multiply that by 6, that's $30,000 of money just sitting there, right? Maybe it's in the bank and it's invested in a CD, so you're getting a little bit of interest. Or Maybe you're investing it in say, a money market fund, which is very safe, but again, you get very low interest. So it's not really earning money for you and might not even be earning enough to keep up with the inflation rate. But it's safe and you can access it if you need it. Well, that's wise because if your car breaks down, you lose your job, whatever, your rent goes up, you can access that money and it doesn't put you into a situation where you have to borrow. So it's a good rule of thumb for us as individuals. Financial advisors will typically tell you some will say 3 months, some will say 6 months, but at least 3 months of your expenses just saved up. Someplace safe, like the bank. So you've got that strong financial foundation. You don't want to invest that money, at least not in any risky way. If you put that money into crypto or stock or something and it doesn't do well, and then you need that money for an emergency, well, maybe it's not a good time to sell that stock. Or maybe that crypto crashed. So you're kind of stuck, right? Well, the same concept applies here for businesses. They should have enough money just tucked away, not really doing anything, but easily accessible, so that they don't have to borrow money. Again, sometimes companies do borrow money because they get a tax deduction, right? That we as individuals don't get, but because it reduces their profits, it reduces their taxes. So they get that benefit, and if they're a corporation, like I said earlier, they don't have to issue as much stock when they have to raise money if they're using some debt. But in general, that they should also have some money just in reserves. Any questions or comments? So let's see, if you do borrow money, well, you have to pay it back, right? That's one of the downsides to borrowing money. You're legally obligated to repay it, and you have to pay interest. You might have to pay some fees if you miss any deadlines. It impacts your credit report, whether you're an individual or a business. The more debt you have, doesn't look good. So too much debt could be a problem. You have too much debt and you need to borrow some more, you might not be able to borrow because the banks will say, sorry, we don't want to lend money to you. Also, even if you don't need to borrow money, for us as individuals, your credit score you might need just to lease an apartment. Or when you apply for a job, they might check your credit score. And if you've got too much debt and your credit score is lousy, you might not get that job. You're thinking, that's not fair. I need the job so I can make money so I can pay off my debt, but I can't get the job because I have debt, right? It's kind of a catch-22. But that's unfortunately the system we have. Not all employers check your credit score, but there are some that will. Let's see. Okay, I think I covered everything else on that slide. So if there are no questions, let's see what else. Oh, we're at our summary. Okay, what do you know? So, as a company is growing, hopefully they've got enough revenue coming in that they can use some of their profits to pay for their expansion. But sometimes companies see an opportunity to expand and they don't have enough money to do that. So then what they could do is raise money through stock or debt, right? Notes payable would be one form of debt. It's a loan that you have to repay either to a bank or maybe to a supplier. Like maybe you bought something from a supplier and they said, just sign this note and you can pay us later, right? So that would also be a note. We learned about bonds where a company can sell the bond to an investor. And what they're doing is they're really borrowing that money from the investor, and then they have to repay it with interest, right? So the bond indenture is the document that has all the terms of that agreement. So the interest payments are based on the interest rate, the amount borrowed, and the time period that the interest accrued over. We know bond selling prices depend on the interest rates. Those market rates go up, bond prices go down, market rates go down, bond prices go up. What else? We can sell bonds at a face value, which is par, at a premium if we offer a better interest rate than the market, or at a discount if the market has a better interest rate than we do. We can use the effective interest method, that's the complicated one, right? Or we could use the straight line method as well, which is the simple one. I already talked about that. The carrying value of a bond sold at a discount increases till it gets to face value. The carrying value of a bond sold at a premium decreases till it gets to the face value. We learned how to journalize when the bond is issued, the interest payments, and when the bond matures. And to figure out the interest expense that actually is associated with the bond, if we're using, well, if there's a difference between the market rate and the stated rate, and we're using the effective interest method, then that's where it gets tricky, right? We have to take the carrying value times the market rate, and then divided by the number of payments. That tells us the interest on the carrying value, and then we subtract that, or we look at the difference between that and how much interest we paid out, and that is the amortization of the discount or the premium. I think that is it. Okay, we're done with the lecture on this chapter. Any questions? We have plenty of time for questions because we only have 3 problems to cover, right? And it's only 1:53. So, stop the recording.